The firm that I work for is called Acuity, and we're really excited to be out here at Digital Ignition and talking to you guys. We kind of start with the so what. We did a bunch of research on why accounting is important, and there's some research about and there's a couple of things on, how accurately you keep your records. These are the relative survival rates of people of small businesses that keep their records, and these are kind of self-assessments from people. But you can see clearly this is a very intuitive thing. Like if I don't keep my records, that probably is some signals for something else also in your business. Up to, I keep excellent records. But the really telling stat is over here on the right. So we talk about frequency and how often you should be looking at your records, and I think there's a 20% failure rate with most businesses regardless. So these were the likelihoods that you would survive correlated to how often you did your accounting records. And if you only do it once a year, you have a 36% chance for survival. If you do it twice a year, you raise it all the way up to 50% chance, 49.9%. If you get to at least quarterly, you get up to 71.5%, and then if you do it monthly, you get to 79%, which is a really to us, I guess it was eye-opening. We see a lot of good entrepreneurs, and we meet a lot of good entrepreneurs. But that the actual statistics actually fell in line with this. It kind of pushed us towards pushing people towards a monthly cadence, at least with their finances, whether that's reconciling your bank statements, whether that's looking at your P&L, balance sheet, whatever it may be. But there's actually a statistical evidence to prove that you should make that part of your monthly discipline. So when we step back, we said, well, technology is pervasive through everything, and what are the technologies that are really kind of coming to the forefront and really helping entrepreneurs? And we settled on these two, QuickBooks Online and Xero, Xero. So these are the two leading cloud-based platforms that are out in the market today. So when we're recommending people if you come to us and say, give us a simple, $20 a month solution, $30 a month solution, technology platform out there to get into this monthly rhythm, this monthly cadence, these are the two platforms we're pushing people towards. And there's some very specific reasons for this, and the marketing would be crying right now because there's very pretty pictures behind these that are getting washed out, but that's all right. So the main reason that we're pushing people towards QuickBooks and QuickBooks Online specifically and Xero, first, all the R&D is going to the cloud. If you look at Intuit, some people are still legacy QuickBooks desktop. If you look at QuickBooks and you look at their financials, and we have because we're dorks, we did some research on their 10K, and it's somewhere in the magnitude of 80% of their $1 billion R&D budget is going towards their online platform. I assume the other 20% is going to new products, and then nothing is going to their old desktop version because everybody's moving to the SaaS environment, right? So that's one reason. So we're just trying not to fight that. But the other one that is even more important is what we call point solutions. So if you think about your business, you might use FreshBooks or something to bill. We're seeing that with a lot of marketing companies. So that's a point solution. So FreshBooks bills better than 50% of the platforms, 60% of the platforms out there. So that's a great point solution. If you see they may keep time in their business, have to worry about billing people hours. So you might have a time reporting, so that point solution becomes very critical, more critical to you than whatever you pick here, right? Like who cares what the repository looks like? So we've recommended these think of them as like repositories. So then when you get to your point solutions, you think of your mission critical solutions, thinking of, FreshBooks like what could be more important than how you invoice your customers? Or in the SaaS world, we're looking at Chargeify. You know, how does a recurring dunning billing system, you know, that's more critical to you, right, than your repository, right? So we picked these two systems for our practice, and we're recommending them to entrepreneurs around because they make the best repositories, which is kind of a counterintuitive, you know, reasoning. I'm not looking at the basic functionality of those systems when we pick them. They're just good kind of holding places, so they do basic reporting well. So when you're thinking about your solutions and how you're picking software, you can pick those two as your repository, so you can go and look at the systems you want more, that are more mission critical, and you can pick those until you get to a size where you can get a comprehensive solution. So this is how we're seeing people really up through the about $10 million in revenue point operate, where you pick the point solutions that are most critical to you, and then you supplement them by a decent repository. And FreshBooks isn't a repository, no matter what anybody says. I don't know if you use FreshBooks. I'm picking on you because almost all the marketing people bill through FreshBooks, but the repository part of that just hasn't made it all the way up. So there's some studies out there that says most people that are doing their own bookkeeping in-house are spending about 80 hours a year doing bookkeeping and keeping up with some of the finances in their own business. So the question to that is, how do you push that down or refocus that effort to more strategic time where you're thinking about strategy or you're thinking about just better ways to operate the business, so get out of the tactical and get to the strategic. So one of the things we're pushing most people to now on the expense side of the house, and what QuickBooks Online and Xero both allow you to do, is bank and credit card integration. So we're really recommending, for a couple of reasons, we recommend that you pick in an early stage business, one bank account, one credit card. You designate those for your business. That means you don't do anything personal in either of those. It doesn't have to be a business credit card. This confuses people sometimes too. But it's just a simple credit card. I actually keep 2 credit cards in my wallet. At the point of sale, when I want to buy something for the business, I use the one I have designated for business. When I buy something for personal, I buy it with the other credit card. What that allows me to do is that allows us to completely eliminate data entry on the expense side of the house. So all of these tools now, they have functions where they can take the data from your bank, they can take the data from your credit card company, and they'll pull in the transactions to the system itself. So both repositories we've talked about, think of the repositories, literally pull this data in. And most people aren't using this functionality. So they're still like going in and typing in, I did this, or they're doing an expense report and they're keeping receipts and doing this. So if you do what we're recommending, if you think about, having a bank, doing a bank, like using one bank and one credit card, you can literally bring 24 statements at the end of the year, and that's your entire population of your expenditures for your company. So, and then if you pull them in through this repository, you have it to drill on in 100 different ways. It's really been kind of cool. Is anybody familiar with this tools? You got it connected?
I'm actually doing Quicken right now, but I'm going to switch over obviously for the business because I'm not doing it I'm doing it personal accounts, not business accounts.
Right. But do you have the bank and credit card integrations? You're using Xero? Okay, excellent. So we're seeing lots of SaaS companies, especially the API integration with Xero. If you have the more point solutions people want, the more beneficial Xero is compared to QuickBooks Online typically. If you like the widgets in QuickBooks Online, which are typically for more traditional businesses, then QuickBooks has a bigger kind of suite. But if you like point solutions that aren't in an app store or whatever, Xero integrates better with their API. So that's normal. That's what we would expect from a SaaS company. So
it's also easier from a technology integration perspective.
yes.
Because .NET is really the chosen architecture for QuickBooks.
Well, philosophically too, we're on the expat council for Xero, so there's 12 firms around the country that sit on the advisory board for them, and they're just much more open to partnerships, feedback, working with people. So open technology. So philosophically, they're actually pulling QuickBooks into that world a little bit, but this is a huge time saver for people because you will literally see, pulled into your records, all your bank transactions, all your credit card transactions, and you can see everything. And it'll allow you to simply pick, this one, my McDonald's coffee, I know that's a meal, and entertainment, or my digital ignition rent, that's rent, that goes straight there. And you can create rules, and there's lots of sophisticated things behind that are time savers too.
Do you find though that there's any kind of a requirement for tax purposes? If you're keeping all electronic records, is there anything that you're needing to back it up with?
Well, if you think about if you're using the credit card and the bank statement, so I know like PricewaterhouseCoopers, like even for their time expense reporting, if you use the Amex, it has enough detail to where that is sufficient for what they consider auditable for their internal purposes. So the things that you might want to, if you start getting into lots of travel or meals and entertainment, those will be the most scrutinized. So the most kind of, I guess where they're going to get the pickiest on you on an audit, which is the so what question, right? Would be mileage. It would be meals and entertainment. So technically, meals and entertainment, you're supposed to document the business purpose and the attendees for that. And then the travel, again the same way. So those will be your top three kind of auditable events. So there's couple camps on that. Some people think that auditors are going to go until they find something anyway, and some people leave that as low-hanging fruit for them and just are going to take the risk. So they say, fine, audit it. You're going to get a finding. You're going to feel happy. You're going to go away and leave me with the $2,000 more of a tax bill. I can live with that. The alternative is back to point solutions. We look at a point solution like Expensify. So Expensify and pushing the documentation. Expensify kind of forces some documentation around who was there, what the business purpose was, things of that nature. And it
connection with the Xero
yeah,
integration.
and it integrates with that. What we're seeing more common, the most common use of Expensify. So when we talk about credit card integration, so the credit card integration we only encourage for the founder or the person with carte blanche spending authority, so you're not trying to put control in place to prevent spending. For Expensify, that's a more traditional expense reporting tool, so we do that with people, your employees, if they have a reason to spend money and need to be reimbursed. So that's a control where their spending doesn't automatically go into the business, where you kind of put that control in place where they submit their expenses. So that's how that point solution also works as well. So there's some functionality in the two systems for that, but we're seeing Expensify work better for that. We're seeing Bill.com work really well for accounts payable. We actually don't accept any kind of bill pay client unless they're on Bill.com. We force them onto Bill.com because it keeps a segregation of duties. So big problem when you hire a bookkeeper is, they have access to your bank accounts typically. So we actually don't take access to bank accounts. We take a view-only access to bank account. And then when we're helping with the payables, we will process the payables, but the approval, the signing authority stays with the entrepreneur. So Bill.com technology nowadays allows that. So this is stuff we used to have to have all these business rules for back when I started out, and now the software is enabling it. So there's some really cool point solutions to allow that. Most entrepreneurs, one of the things we're trying to do is get that education out there, because a lot of entrepreneurs don't understand some of the functionalities there. Like if you have the super user access to bill.com, then you can override that. Well, now you don't give that to your bookkeeper, right? You keep that, and then you assign them those tasks. I mean, we split that up, our function in our in-house. We have a different person with the super user access that has the authority to process the bills all the time.
So you would use that in addition to the Xero capability?
Yeah, we use Expensify, Bill.com. So we use all the point solutions, Chargeify, people want, Stripe, any of the, we work with a lot of SaaS companies, so we do integrate a lot of the recurring billing platforms into Xero. We tend to push people towards Xero in those situations. So we had billed that we're going to talk about some of the reporting and some of my favorite reporting, and clearly there's some basic reports. Accounts receivable is my favorite report, but I mean, and my least favorite report all at the same time. So who owes this money? Who do we have to stay on top of? Accounts payable is obviously one. But I wanted to talk a little bit about the profit and loss statement. And I can't, maybe we can get rid of that. So I made a really, really simple profit and loss statement. And this is a September statement. And my question here is, if I just had this information, because a lot of people look at their profit and loss statement on a monthly basis. If you just had this information, just sitting at it cold, like, can you tell me much about this company? I mean, you can say it's kind of break even. They have some kind of gross margin and profit in doing this. So even in your own company, I don't think ever looking at a singular month is that helpful. So my favorite report, and Xero defaults to this, QuickBooks doesn't. My favorite report is maybe a report, is a report that shows months in sequence. So this is the same month right here, right? And I usually look at 6 months, but it got really busy on this slide, but I wanted to do more than a quarter. So when I looked at, okay, a quarter ago, kind of that happened. When you're starting to look at this now, then you can do some real analysis to me. So I can say, okay, I've got a relatively positive trend here. I probably need to look at why my margin peaked, a couple months ago. And if I can get 30, let's get 30% like going forward. We can start drilling down and looking at this. But then I come to sales and marketing and I'm like, oh crap, why is this all over the board, right? And then I remember Salesforce.com is really expensive and they make me pay quarterly. So now I have something, I have $5,000 in each of these months. Now I have something in my head where like, oh, I need a cash flow plan for 2 months from now for another $5,000. I can kind of look over the last quarter and see I'm slightly positive. Maybe I can take a paycheck this month. Maybe I can think about that. It's funny because it's true. It's funny because it's true. And I can look at my G&A. And I'm thinking, okay, that's relatively, I might drill on here to do this. One of the nice things about doing this in Xero and QuickBooks, and one of my favorite thing about having those tools is that you can look at a simple view like this, and we recommend it very highly, looking at simple views, because you have an infinite amount of data down here. You can look at every transaction, you can look at the timing, and with a click of a button. So you can click, drill, sort, however you want. You could sum these up and look at all 4 months together. You can export it, look at it by vendor. You can do it, slice it and dice it however you want. So one of the things that's done is I'm encouraging people to have a limited number of line items like this on their top level financial statement. There's people ask me all the time, like, what should I capture? Like, what information should I capture at what level for this top level income statement, profit and loss? You hear it have many names, right? So I have a simple rule for that. So you start with compliance. So you start with kind of the end in mind. So like, when am I going to have to use this for somebody other than me? So most people, 99% of, or 97, I think, percent of the companies, you know what their only compliance is? U.S. tax return. Do you know how many line items you have to capture for an average business in a U.S. tax return? Like line item level, how much detail you need to capture? Any guesses? 1 million? 1,000? Come on, somebody bold. 3, 5? Somewhere between 5 and 10. I've seen profit and loss statements that are like 6 pages long. Like people like getting into the like, ooh, I went to Arby's. There better be an Arby's line item. You look at me like that, and I have seen Arby's on a P&L is pretty bad. So just remember, when you're starting, like the only things you have to have are compliance related, because that's going to help you at the end of the year, right? Once a year. So the only other reason outside of that you should ever add is this if it's going to help you make a better business decision. So that might mean if you're doing a PPC is a big thing in your business, like mission critical to your business, that a pay-per-click campaign might be that might be a mission critical line item for you. If you have a business, I could see in a SaaS business where you would want your marketing spend in a separate line item than your sales spend. Because you're going to see this trend and you're going to want to look at how this trails, you know, from those two numbers, right? And then you can do some analytics on the top surface level. But we're still starting with 5 to 10 things. I mean, you're starting with revenue, because you can drill on revenue 8 ways till Sunday. And you don't even, most people, you know, start adding, like, I could have got that if I just drilled on it and looked at it. So we try to encourage people not to, you know, break that out too much. Less is more a lot of times. The biggest problem we see is people add these line items, and then you'll have 10,000, 4,800, 6,000, 11,000, some variance you should look at, and the line item before it might be 0, 0, 50, and 0, like $50. You know where people's eyes go? Like, what is that $50? Like, who cares? Let's think about the $5,000, guys. Like, these fluctuations, like, let's get focused on, like, the big 50,000 foot, like, big stuff when you're in your P&L, okay? That's the stuff we want people focused on. So don't just go back to, like, don't just add it. Like, do I really need a line item that's called whatever? The one line item we did add that's not on the that's not on the tax return. That's my favorite one. Is some meals and entertainment is 50% deductible. So you got to watch what you put in there. So we now have an employee events category. So The employee events is 100% deductible. So, or at least in our tax person's interpretation. So I do have an employee events line now in addition to meals and entertainment. So that's a little bit different. So that's a pro tip. That's for free. There's lots of gray. There's lots of gray in the code, but there's a real reason for that, right? Because you got to get that compliance right. There's enough of a penalty for the meals and entertainment being 50% deductible. So that's what we had kind of canned for you guys today. That was kind of that's kind of the 50,000 foot kind of philosophical / some a bit tactical. So I was going to open it up for questions and see if you guys wanted to dig on anything else.
I kind of have a question, something I always struggle with. I have
Sure.
two companies. This is my new startup. I started about a month ago. Still my old company. I track mileage. I use Everlance, I think now, because it auto tracks my mileage. It's free.
Yep.
It drains my battery to death, but it makes tracking my mileage really easy because it auto tracks all my trips. Well, how do I put that in? Because I always struggle with how do I break that in, or should I be doing like actual expenses on inside my software? Should I be doing like all my gas, all my car expenses on my business credit card and figuring it out later, or like how do I do that split and get that in properly?
So the mileage, because it's a non-cash technical one, that can be something you do, like you can keep that record for your tax person and give the tax person at the end of the year.
Yeah.
So that's option one. Option two, you are allowed to do gas, like actual like gas charges and maintenance and things like that. So like if you have, like for two companies, I would literally have two bank accounts, two credit cards, one for each, and I would swipe separate for them.
And just, I mean, like there's.
I don't like tracking mileage, so I do gas.
Even if I just have one, just go into one. Would I actually just swipe every fill up and put it into and then back it out later? I decide on the point of purchase. Like if I'm on a family vacation, I don't, and if like all the rest of the time I'm pretty much in business mode, so I do. So I literally make a decision at the point of purchase. You do actually.
Yeah. Well, I mean, I do actual expenses just because it's easier and I don't want to track mileage. Any other questions? This was the one that, sometimes people get really hosed up in, because then what happens is if you get 40 lines in there, your 80 hours now gets 160 hours because you're like scrolling through the list of like, which one is this? Okay, did I have a list for, events in, outside of this market, when I go on a field trip, you're just like, you can see like these lists of accounting. Like I literally, the worst one I've ever seen was somebody set up the individuals, like they're all their employees, and it like in the general ledger in the top one, it would be their name, their Social Security withdrawal, their federal tax withdrawal, like not even getting into like privacy issues, like so like they would print out their P&L and it was literally like 12 pages and every employee and all their deductions were on the face of the financial statements. I almost started weeping, so there was a tear that came to my eye, so that was pretty bad. So yes, you look at me like you're surprised. We're working with 350 startups. We see everything. From like, I haven't done accounting ever. We need to file 4 years of tax returns to like, whoops. Yeah, 8 years was the worst we've seen. They had lost money the whole time too. It was an easy tax return. They're just taking risk. To these line items, we're just like, man, how do you even unwind this kind of craziness? So it's pretty funny.
I always just take the default in the chart of accounts from zero. Like that's how I did it. Is like the default that they had there. So would you recommend tidying that up then and reducing some of those?
I would actually. I recommend reducing those a lot of times. I recommend taking literally your tax return from last year, Start with that and saying, the meals isn't on the first sheet. Just remember that's deductible. So that's only 50% deductible, in charitables if you do that through your business. So that's not on the face. That's in the schedules. So I literally take my tax return. I've blogged about this. Like I literally take my tax return and say that's what you start with. Because especially if you're not in a cadence of looking at it, like why would you want complexity? Let's just get through this. What's the best one? Close enough. Here we go. And then when it looks weird when you pop out, like insurance, does that look weird every time you do it? It looks terrible every time we pay insurance because we're cash basis. So like if you look at my P&L and insurance, it's like February, like big lump number, right? And then the rest of the months look like nothing. Like why do I have that in a separate line item? If I put that in general, I would know. I could drill on it. Oh yeah, the insurance payment was that month. So there's not much to some of those line items. So
when you're trying, because there's multiple things obviously that you're trying to do as a small business. One of them is to attract investors or to support with your bank even, right?
Right.
Because you're making a case that you're new, you're not really that creditworthy, whatever. In the services business, we also, there's a new, cost of goods sold issue that's continuing to pop up. And what seems to be common in a software, a SaaS business, is, taking some of the service part, right, particularly customer support, right, as part of cost of goods sold. What do you normally advise, or do you normally come across that in terms of, how people account for it?
So, to me, it goes back to how you're going to use the information, right? So when you're starting to, so payroll is one of the first journal entries where we see people start breaking things out. So we usually see it at the person level.
Right.
So if you have 10 people and 2 work in customer success or customer service or field service, you might have a field service and it might roll up to salaries up top in our cost of goods sold, and 2 might roll up into G&A.
Okay.
So we do it.
You do it at the person level.
I do it at the person level, primarily because of the ease of application, and I dedicate them fully to one. I just pick the one they're most in.
Yeah.
Because the reports are so good. If you put them in departments in the different payroll tools. So most of the payroll tools have great departmental reporting that can let you post the entry. I don't necessarily, like a lot of the times I'll still put the payroll tax just down below, like I won't fully load it. So it's just a matter of directionally, are you getting the right business decision made? The investor question is a different question altogether. So if you get an investor, so right now what we're seeing, and we work with a lot of companies that go through the funding cycle. So if you go through and get, say, $1 million, like you're still here. You're still in U.S. tax return territory. Most of your investors don't care. They're like, if they do care, you say, you want us to spend another couple grand on accounting? We can get you more, GAAP financial statements. And they say, no. So there's like 24 grand a year? No. Well, let's use that on product, and let's use that on services, marketing. Let's use it on dev, things like that. So where we see it come into play more traditionally is at the $3 to $5 million investment. The compliance requirement changes. So once you go from your minimum requirement being the U.S. tax return to being a financial GAAP audit. So when that happens, what we do is we add a second level resource. We add a mid-level resource called a controller to people's engagement. So that's a trained CPA that's going to be helping you. Now you're coming into, now we're not making entries because of better business decision. You're making entries because of rules. So we're deferring revenue. We're doing the cost allocations based on your industry standards. You're doing things of that nature. So that's much more expensive of a cost. Like our average customer, we're able to do the compliance function, a U.S. tax return for like The average person's paying $550 a month. The low is like $200 a month. Once you take it to the next step, it goes up to like $3,300 a month is the average. So it's a 6x for a small business kind of costs change, which is why we push people. Like there's no reason, like from a business perspective, to push people towards more expensive, complicated accounting, because that just is unhappy people and you're doing bad things. I mean, you're not helping, because most of the better business decision stuff does not come with GAAP reporting. So that's, if you ever looked at a GAAP report, and I've looked at so many in my life that it's just not even funny. You know, I had situations where I've been in an audit, like a public company audit committee meeting, and the only person that cared about the answer, the correct GAAP answer, was me and our national partner, you know, who was doing it. The board didn't care. The stockholders didn't care. The CEO didn't care. The CFO didn't care. They were just like, tell us the answer. We don't care what it is. Everybody's going to, same thing with venture capitalists and private equity. They're like, we're going to back it out anyway. Like it's non-cash. It's like some nonsense entry. And like, so I don't, that's my way of saying, and on my soapbox, that you know, there's lots of things you have to do when your compliance changes. My personal philosophy is to push that off as far as possible, and being transparent with people. We're like, yeah, 6x cost. I'm more efficient with my money, and I manage the business better because I've got no noise running through I've got a cash basis P&L that I'm walking through right now. I'm happy to take it to the next level once you write me a $5 million check. You know.
And you know, whether you're doing it from an investment perspective or you're just trying to continue on, right, in your growth, which improves your bank relationship as
right.
well, right? So if you're organic and you do get to that kind of level of, you know, flow in the business, what strikes me is that, you know, you want to understand, because I just stepped out of an environment where we had hundreds of millions in, you know, services-based revenue.
Right.
So it was really important for us to recognize GAAP.
Right.
And we did it as a matter of principle for our own purposes, but it was based on modeling that we were using on our own reports. It wasn't necessarily just for compliance purposes.
Right. So you're using it to make better
exactly.
business decisions. And at 100 million in revenue, you're also comparing yourself to other people, and the only way to do that is through those reports. Under 10 million in revenue, where 90% of the companies are, the bank, they don't care about your financials. They want to see your tax return. They want to see what you put on your tax return. And they'll ask for your financials too, but you get 100 questions on why it doesn't match your tax return. I promise. I've been through this a couple of times personally. So
because my inclination is, as I prepare to get there, you know, that I'm using financial models that I pulled outside, that I use from a reporting perspective, not necessarily even the software and the services that I have from an accounting perspective. But of course, I want those to marry together as much as possible. So I guess, you know, the short answer is, as you need it for better business decisions, right? When compliance hits you, compliance is going to drive the whole situation no matter.
well, the compliance is your minimum, and then you add complexity for that, and only for that.
Was when you have compliance issues that are related to big investment or
Yeah.
public trading or something like that.
That changes the complexity. This is a dynamic thing, even with the tax code, right?
Right. Okay.
So you have to be prepared to do that. But if you have that as your frame of reference, I think you make more healthier decisions, I
Right.
think.
But I mean, zero is going to carry me as far as any of this goes in terms of what I do and how I prepare.
Yes.
But I think, you know, when we get to that level, it's a whole different discussion.
Right. Cool. We good? Thank you all.